Hello, my dear student. How are you all? I hope everyone is fine and doing great. Today, I am here to have a discussion on common conceptual mistake which a student may commit in CA final financial reporting paper. Based on my experience and based on a doubt which I received in my Telegram group, I normally come out with such type of video. I have already prepared 3 videos on common conceptual mistake which may be referred by you from the playlist for which the link has been given in the description of this video. Means this is my 4th video on common conceptual mistake. So what is the topic for today's discussion? The topic is very important topic from financial instrument chapter, that is market rate of interest versus effective rate of interest. Normally, I will say most of the student will have a doubt on this topic. Even if I am a student, even though this chapter was not in my is this chapter was not in the syllabus when I was student, but if I am a student, I will have also a doubt on this topic. Be as a student, I will have also a doubt on this topic. Means a very common doubt: market rate of interest, effective rate of interest. Means when to use market rate of interest, when to use effective rate of interest. That is a doubt. Now, from this chapter, we all know that interest income and interest expense are recognized by applying EIR. By applying EIR. But when you do solution from ICAI study material, in some of the questions they have calculated interest income or interest expense by applying market rate of interest. And if effective rate of interest is given, then in some of the question we are calculating interest income and interest expense by applying effective rate of interest. Now, of course, there is no doubt the doubt will come when you are not conceptually strong. Means I will say actually there is no doubt on this topic, but the doubt will come when you are not conceptually strong. Correct? Means if I will say a very simple point, already I have said that interest income and interest expense will be recognized by applying EIR, but by referring institute solution, suggested solution, you will feel that in some of the question ICI have used market rate of interest. In some of the questions, they have used effective rate of interest. Now, one doubt will come: when to use market rate of interest, when to use effective rate of interest. That is the doubt. But to have a discussion on this, I need to give a background of this chapter. So first, I need to give a background of this chapter. Then only I can come to a conclusion for this doubt, common conceptual doubt. Understood? So, what is the background? Let us come to the background. We have all done financial instrument chapter in AS 32, in AS 109. Now, as per Ind AS 32, financial instrument is a contract which will give rise to financial asset for one entity, and for another entity it will give rise to financial liability or equity instrument. Now we all know that financial asset and financial liability will be initially and subsequently recognized, recognized as per Ind AS 109. However, equity instrument is not covered under Ind AS 109 because equity instrument is not subsequently recognized. Equity instrument will be initially recognized at the consideration received, which whatever consideration has been received at that amount, it will be initially recognized, and that will be the carrying amount of the equity instrument. Correct now? Understood. So we are not discussing anything about equity instrument right now. We are not discussing anything about equity instrument right now. I hope you understood. Means our discussion is based on financial asset and financial liability. Now, for initial and subsequent recognition and measurement, Ind AS 109 has classified financial asset into 3 categories. We all know that financial asset can be measured at FBTPL, FBTOCI, and amortized cost. Similarly, financial liability for initial and subsequent measurement is classified into 2 categories, that is FBTPL and amortized cost. Correct? This much we know. Now, we all know that if financial asset is measured at amortized cost, is if financial asset is measured at amortized cost and financial liability is measured at amortized cost, means right now my discussion is on amortized cost, not on any other classification. So if financial asset is measured at amortized cost and financial liability is also measured at amortized cost, means when we will measure amortized cost, when financial asset will represent contractual cash inflow and financial liability will represent contractual cash outflow. Understood? And they are not held for the purpose of trading. And they are not held for the purpose of trading. Means my concentration is right now only on amortized cost because I am discussing this point from examination point of view. Yes, sir. Yes, sir. So we all know that initially financial asset will measure at fair value plus transaction cost. Yes, the financial liability will be initially measured at fair value minus transaction cost. This point you all know. Correct now. Now the point is that what is this fair value? Means how to determine this fair value. Correct. Now the point is that how to determine this fair value. So this is based on whether the instrument means whether the contract is done at market terms, whether the instrument are at market terms. If the answer is yes, then what need to be done? If the answer is no, then what need to be done? Now, if the instrument are at market terms, means can I say contractual rate of interest is equal to market rate of interest? Yes, sir. Then fair value will be equal to transaction price paid or received. Means in case of financial asset, it will be transaction price paid. In case of financial liability, it will be transaction price received. So fair value will be equal to transaction price paid or received. But if the instrument is not at market terms, then we need to find out fair value. In that case, fair value will be equal to present value of contractual cash flow discounted at market rate of interest for similar instrument at same credit risk. Understood? I hope this all point you know. Means I'm just giving a background right now. Correct? So can I say if the instrument are not at market term, then we need to find out fair value. Fair value will be equal to present value of contractual cash flow discounted at market rate of interest. Means can I say fair value is calculated by discounting contractual cash flow at market rate of interest. Means to find out fair value we require market rate of interest on the date of inception of this contract. Yes sir. Yes sir. Means when I am saying the instrument are at market terms, then contractual rate of interest is equal to market rate of interest. Means this transaction price is nothing but fair value of contractual cash flow discounted at contractual rate of interest only, which is nothing but market rate of interest. Means when I am saying transaction price, so in this case, when the instrument are at market term, so this transaction price is nothing but a present value of contractual cash inflow outflow. Inflow in case of financial asset, outflow in case of financial liability. I hope you are understanding. So can I say this transaction price will be equal to present value of contractual cash inflow outflow discounted at market rate of interest, and in this case market rate of interest will be equal to contractual rate of interest. Understood? But yes, in this case when the instrument are not at market terms, then contractual rate of interest is not equal to market rate of interest. Then you need to find out fair value. Fair value will be equal to present value of contractual cash flow discounted at market rate of interest. Now once you have determined fair value, then the second point is that is transaction cost incurred? Is transaction cost incurred? Means when you purchase any financial asset or when you incur any financial liability, there may be some transaction cost. So is transaction cost incurred? Correct. If the answer is no, then can I say initial recognition will be done at fair value? If the answer is yes, then initial recognition for financial asset will be fair value plus transaction cost, and for financial liability it will be fair value minus transaction cost. I hope you understood. So can I conclude in this case, can I conclude that fair value you have determined? Fair value is based on whether the instrument is at market terms or not. Understood? So if the instrument is at market terms, then fair value will be equal to transaction price. Correct? If the instrument is not at market terms, then we need to find out fair value based on market rate of interest. Based on market rate of interest. Then initial recognition will be done at what? On the basis whether there is a transaction cost or not. So is transaction cost incurred? If the answer is no, then initial recognition will be done only at fair value. Correct? And if the answer is yes, transaction cost has been incurred, the initial recognition in case of for financial asset it will be fair value plus transaction cost. For financial liability it will be fair value minus transaction cost. Correct. Now coming to subsequent recognition. Now in case of subsequent recognition, what Ind AS 109 says that it will be subsequently recognized at amortized cost by applying EIR. Understood? So you can see subsequent recognition is done at amortized cost by applying EIR. Understood? I hope you are understanding. The subsequent recognition is done at amortized cost by applying EIR. What is amortized cost? Amortized cost is equal to amortized cost will be equal to opening balance plus interest expense minus contractual payment. This will be the closing balance, and this closing balance will be amortized cost in case of what? Financial liability. For financial asset it will be opening balance minus plus interest income minus contractual receipt. This will be the closing balance, and this closing balance will be the amortized cost. So this interest expense and interest income will be calculated by applying EIR. Understood? Not by market rate of interest. Understood? So this interest expense and interest income will be calculated by applying EIR. Now just try to understand what is EIR. We need to understand what is EIR. So EIR is the rate of interest at which at which rate of interest at which, correct, now present value of contractual cash flow, rate of interest at which present value of contractual cash flow will be equal to initial initially recognized amount, a recognized amount. So EIR will be the rate of interest at which present value of contractual cash flow will be equal to initially recognized amount. So can I say in this case when there was no transaction cost, initial recognition is done at fair value, and can I say EIR will be equal to market rate of interest in this case, because can I say this is the initial recognized amount, and at market rate of interest present value of contractual cash flow will be equal to initial recognized amount, means in this case can I say EIR will be equal to market rate of interest. Understood? So can I say when there is no transaction cost, when there is no transaction cost, so initial recognized amount is fair value. So can you see in that case EIR will be always equal to market rate of interest. It means interest expense will be calculated EIR and EIR will be equal to market rate of interest. Therefore, in your institute solution, they are actually calculating interest income or expense by applying EIR only, but because there was no transaction cost, they have taken market rate of interest. Understood? Understood? Understood means as per concept, interest income and interest expense will be calculated by applying EIR only. Understood? But if there is no transaction cost, EIR will be equal to market rate of interest. But in this case, when there is a transaction cost, you can see initial recognized amount has been changed. Now it is not at fair value, it is at fair value plus transaction cost or fair value minus transaction cost, as the case may be. In this case, can I say EIR will be is required to be calculated, and EIR will be the rate of interest at which present value of contractual cash flow should be equal to at this amount. Of course, can I say at market rate of interest the present value of contractual cash flow will not be equal to initial recognized amount. Therefore we need to recompute EIR. We need to recompute EIR. Why? Because as per Ind AS 109, this transaction cost will not be charged to PL as an expense immediately. This transaction cost will be spread over the tenure of the contract as either as a interest expense or as a deduction of from interest income. Understood? As the case may be. Understood? So this transaction cost will be amortized. This transaction cost will be amortized over the period of the contract. Over the period of contract, and therefore we need to calculate EIR. So in this case, can I say we are calculating EIR, and in this case EIR will not be equal to market rate of interest. I hope you are understanding. So can I conclude in this way? What conclusion we are drawing? Ki always interest expense and interest income will be calculated by applying EIR. We can now make a conclusion if there is no transaction cost. If there is no transaction cost, can I say EIR will be equal to market rate of interest? If there is transaction cost, then EIR need to be recomputed. Why? Because in this case EIR will not be equal to market rate of interest. Understood? Understood this point? Yes. But for calculation of fair value is always calculated by applying market rate of interest. Understood? Understood means I will just give one more point. Suppose this is the date of initial recognition and this is the date of subsequent recognition. Now on this date you want fair value. So this fair value will be calculated not based on EIR. This fair value will be calculated based on market rate of interest on this date. Understood now? Means even though initial recognition was done at fair value, but subsequently if you are calculating fair value, so subsequently the fair value will be calculated by applying market rate of interest on this date, not by applying original EIR. Understood? So whenever you calculate fair value, then you should consider market rate of interest on that date when you are calculating fair value. But interest income and interest expense will be always calculated by EIR, by taking EIR into consideration. Yes, now we can conclude that if there is no transaction cost, then EIR will be equal to market rate of interest. If there is a transaction cost, then EIR will not be equal to market rate of interest. EIR it will require recomputation. Understood? By using the concept of IRR, internal rate of return. Yes sir. One more point I just want to conclude, that in this case when contractual rate of interest is equal to market rate of interest, correct now, and there is no transaction cost, then of course EIR will be, we can say that EIR will be equal to contractual rate of interest. Understood? So sometimes the doubt may come, contractual rate of interest versus market rate of interest versus effective rate of interest. Understood? So of course in this case, if there is no transaction cost, then of course EIR will be equal to contractual rate of interest, which is equal to market rate of interest. I hope you have understood whatever I have said, and this will be a very this will be a effective discussion whatever we have done, and I hope I am able to create whatever doubt was in your mind. So if you have understood, please mention in the comment box, yes sir, we have understood whatever you have said. And one more point, if you have any doubt, or if you find that there is any concept in which you are getting some trouble, please in the comment box you can mention that topic. I will come with a video on that topic also. Understood? So anytime you are free to mention any topic, any, if I feel that of course it should be a common doubt, so I'll come out with that topic. Understood? Thank you very much. All the best. Bye bye. Take care. Enjoy your remaining day and enjoy your study. Bye bye.